Okay, so we're going to look at an example now of different inventory costing methods. NASCAR Unlimited sells remote control cars. The company has the following beginning inventory and purchases for the year. So their beginning inventory on January 1st is 120 units at a unit cost of $20 per unit for a total cost of $2,400. On August 15th, they made a purchase of 180 units for a unit cost of $15 per unit, and that's for a total cost of $2,700. So their total number of units available for sale is 300, and the total cost of this inventory is $5,100. Because of technological advances, NASCAR Unlimited has seen a decrease in the unit cost of its inventory. Throughout the year, the company maintained a selling price of $30 for each remote control car and sold a total of 280 units, which leaves 20 units in ending inventory. We're going to calculate the cost of goods sold and ending inventory using the FIFO method, the LIFO method, and the weighted average cost method. You may want to pause this so you can take a screenshot or write down this information. I will not have this information on the next slide. Okay, let's start with the FIFO method. Now your cost of goods available for sale is going to be equal to the cost of goods sold in your ending inventory. So we're going to go through the purchases, the number of units, or unit cost and total cost, and we are going to calculate that information based on cost of goods sold and ending inventory. So the first thing we're going to do is we're going to start at the oldest purchases, or the purchases at the beginning of the year, because the first ones we purchased are the first ones that we're selling. We sold a total of 280 units, and we have 20 units in our ending inventory. So we'll start with January 1st. On January 1st, we bought 120 units. We bought those for $20 a piece for a total cost of $2,400. Now, out of the 280 units that were sold, 120 definitely fits in that. So all of this cost, $2,400, is going to go into our cost of goods sold. The April 15th purchase, that was for 180 units. However, we are not going to include all those units into our cost of goods sold. So we're going to split this one up. We're going to split this up into the one that fits the cost of goods sold and the one that's going to be the ending inventory. Now we know from the information on the previous slide that there were 20 units in ending inventory. So I'm going to put a 20 here, okay? So out of the 180 that were purchased, we know that 20 are in ending inventory. So 160 of those units were sold. So 160 units were sold at $15 each. And that's going to be $2,400. That $2,400 is part of our cost of goods sold. In the ending inventory, we had 20 units at $15 a piece. So that's $300. That's going to go under our ending inventory. So total, we had 300 units. We had a total of $5,100 spent on the inventory. The cost of goods sold is $4,800. I got that by taking $2,400 plus $2,400. And our ending inventory is $300. This is the FIFO method. We have a cost of goods sold of $4,800, an ending inventory of $300. Okay, now we're going to calculate cost of goods sold and ending inventory using last in first out, or LIFO method. So in this case, we are going to assume that the purchases that we made most recently are what are sold first. The last items we purchased are the first ones that are sold, okay? So in this example, I'm going to go ahead and start with the August 15th purchase. So on August 15th, we had purchased 180 units at a unit cost of $15 a piece for a total of $2,700. Now remember, we sold 280 units and we had 200 left in ending inventory. So this 180 definitely fits in there, okay? And this is going to go under our cost of goods sold. Now for the remaining units, on January 1st, we had a total of 120 units available for sale. Now we need to get our cost of goods sold, the number of units sold, to 280. So 100 of those are going to go to cost of goods sold, and 20 of those are going to be in our ending inventory. Now, the January 1st items, the unit cost was $20 a piece. So 100 times 20 is 2,000. 2,000 is going to go into our cost of goods sold. 20 times 20 is 400. $400 is going to go into our ending inventory. The total units available were 300. The total cost of these units was 5,100. The cost of goods sold ends up being 4,700. And the ending inventory is 400. This is using LIFO. Okay, finally we're going to look at the cost of goods sold and ending inventory using weighted average cost method. Remember, this one looks a little bit different than LIFO and FIFO. To get your weighted average unit cost, you're going to take the total cost of the inventory and you're going to divide that by the total available units. So in this case, 5,100 divided by 300 units is $17 per unit. And to determine our cost of goods sold, we are going to take the 280 units that we sold times $17, that unit cost per unit, and our cost of goods sold will be 4,760. For our ending inventory, we're going to take those final 20 that weren't sold times the $17 weighted unit cost, and that's going to be $340.